Hey guys, Chills and Day here with Chrono Historia. Today we're going to be talking about the methodology of investing in emerging markets, how to do it and not lose. A lot of people understand that emerging markets are kind of a very great way to generate alpha in your portfolios. However, a lot of people fail to understand the risks associated with emerging markets and how to best create a position in a portfolio. Why this article matters to you, it's pretty simple. If you understand how to invest in emerging markets, you can pull upwards of 25-30% out of a position yearly gains. Um, Now, there's risks associated with it, but the good thing is when you're doing global macro positions like this, global macro investing, you don't hedge intrinsically from the position, but you can take like other hedges such as other competing economies. So to keep it simple, this is just gonna be another tool in your toolbox. That's why it's called a methodology article. That when you see an applicable situation forming in the market, you can go ahead and scrape some alpha. Anyways, let's jump right into it. So for the past 10 years, emerging markets have been the frontier of high return investment methodologies. This is true for global macro funds, and now to some degree, quant funds are starting to get into it as well. Uh, Mainly due through like semantic linking of words and like congressional reports, for example. That's a different type of methodology we can go into later. So yeah, in this article, I'm going to give you everything you need to know about investing in emerging markets. I'm outlining a theory of why this works, the methodology, previous return, risks, and how to set up in your portfolio yourself. So the goal is to get you squared away so you can make sound decisions. So yes, again, this is Chrono Historia. This is the website I own and manage. And the whole point we do this is to teach people how to generate above market returns, alpha, in their portfolios. I constantly publish articles that go over investing research methodologies and tips and tricks of the trade so that you're better prepared to earn in today's crazy economy. Basically, I'm going to give you the tools, and it's not going to by themselves they're worthless, right? This is just if you see something developing in the market, you'd be like, oh hey, this is an applicable strategy I can use for this, and it's all about like how to risk reward hedging properly, and if you do it right, you can make a lot of money. So typically this type of knowledge is more reserved for like professional analysts, but not many people know how to do it themselves, and that's what I'm here for. So let's go right over it. So what is an emerging market? So for those who are unaware, there's three types of markets in the world. You have developed countries. This is things like USA, Japan, Germany, and the United Kingdom, amongst many others. Emerged markets. These are things that were in emerging markets, but they've fallen into what's called the middle income trap, and I'll explain that later. Then you have emerging markets. These are like China, India, Mexico, Nigeria, pretty much all of Africa except for South Africa. That they're in like this emerging market category. Russia and Iran. Now, what this means, it doesn't mean it's a first world or third world or second world. It's just the current state of innovation within the country itself. Um, Emerging markets are characterized by massive, massive rates of innovation uh, and a kind of a laissez-faire government attitude towards it. And because of that, resources can be extracted at whim. Typically, wages are they're rising. And we'll get all into this, but it's an amazing time to position an investment. So let's jump right into it. So developed countries have strong economies, established political system, and permeable social class structure. Think about the United States. By working hard, you can, in theory, work your way up. Uh, that's what characterizes developed economies. And usually, what it comes down to is talent acquisition. Developed economies can soak up all the available talent in the world because they pay the most at the highest standard of living, et cetera, et cetera, et cetera. Emerged markets are characterized by a fledgling middle class, a rise in tourism, and an economy that is starting to stabilize. So in an emerging market, the economy will be all over the place. One year they'll be in tourism, the next year they'll be in manufacturing, maybe the third year they'll be in mining. Who knows? Emerging markets, they have a codified economy. They're stabilized. And typically the political system is usually has a high degree of corruption within the political system. And what ends up happening is innovation starts to go downwards. The rate of innovation. Businesses aren't really opening up because there's like monopolies and stuff in countries. And it's usually bolstered by the government. And this is because the government kind of has to, but we're not getting into the social kind of demographics of that situation or why it has to. But just know that emerged markets usually have a high degree of political corruption and stabilized economies that are usually built around a couple monopolies or oligarchies, for example. Emerging markets, on the other hand, are characterized by massive levels of business innovation, high resource extraction, a shift from authoritarianism to free market capitalism, and you see the first start of the middle class. Uh, what defines the middle class are people who make enough money to afford for future goals, for future products. They can engage in consumerism. They don't make their own stuff. not saying they don't make their own stuff, but they don't make like clothes. They don't grow food. They can go out and buy it because they have discretionary income. And this leads to a consuming population, which thus increases GDP within our industrial economies. So the important thing to remember on emerging markets that are good, there's three reasons that they're good for investments. One is the transition to a free market capital economy. This is massive. This is why we invest in emerging markets. For the first time, they're like, okay, we can create factories, we can do all this stuff, we can put the population to work, and because of that, GDP explodes. Massive levels of business innovation with the explosion in GDP. Everybody who's starting a business is like, hey, I can do this better. This product hasn't been serviced properly. We can extract this resource, etc. And as a result of this, generally speaking, the wages across the entirety, the average wage across the entirety of the country, or whatever emerging market it is increasing, and that allows for a fledgling middle class. And this is very, very important because then this fledgling middle classes we'll get to later will start buying things. And when people buy things, that's a flow of wealth that you can invest in and make money. So this is the general theory behind why investing in emerging market works. This is important because we have to understand the theory before we can build the method, the methodology for which we invest with, the vehicle that we can, cookie cutter paste to different investments. So it's very important we understand this. So like I said, every single investment methodology has to have a theory that supports it. Emerging market investing is no different. So this is the nutshell emergent market theory. This is hotly contested by academics, but this is what basically, this is the line that it follows. Emerging markets are distinguished by a large growth in manufacturing and resource consumption. With a growth in manufacturing, so comes a growth in wages for factory workers. Further, those who hold property that extract the natural resources, so if you own the land that the mines are on, the forests, they see an increase in their total value. They build businesses to extract these resources, or extract or refine, or you get the idea. Uh, Both of these increases, right, factory labor wage and natural resource costs, results in a rise in the average wage across the emerging market, the development of the middle class I was talking about. With this rise of wage comes a rising standard of living. From this, we can see the development of a middle class within the emerging markets. This middle class, in turn, turns around and reinvests into their local geographic community. They start to buy goods and products to distinguish their status. This is important because the goods and products they buy, they emulate those in society who they want to be. We saw this with the Industrial Revolution, America in the 19th century, and many, many emerging markets. There's statistics, and all these are backed up with sources. You guys, I highly recommend you check them out. They're really great articles. When people start getting money, they start to emulate people, right? And then further, this developed middle class, this fledgling middle class, starts to build their own businesses, right? So they're trying to further increase their growth, which further increases the GDP, the local value of the community, etc. This leads to large-scale innovation. Basically, businesses are building on top of each other, left and right, left and right, left and right, and this increases GDP massively. What that means is investments in this region are just going to, I'm not going to say succeed, but when they start kicking off, you're not going to see like 5-6% growth. You'll see like 15-20% growth, like year over year, just insane growth rates because there's not really any competition they have to worry about, or it's an open market. This is why we invest in emerging markets. It just, everything's set up to explode, and thus the cycle repeats until the emerging market becomes the emerged, right? And then we see the middle income trap, and we'll get into that in a little bit, but that's the underlying theory of it. So all you got to remember is that in an emerging market, there's a lot of innovation, a lot of growth, and you can hop on that train. So let's create the methodology for how you invest in this, right? So now that we understand how the emerging market works, we have to discuss how we can position an investment to make money off of it. This is the important part, right? The income generating part. So the trick is to find an emerging market. Luckily, all of these are pretty widely known. India is an emerging market. China is in a weird category. It's considered emerging within the countryside, but the cities, those are more codified and solid. So kind of that discrepancy between rural and city within China is considered an emerging market. Pretty much all of Africa is emerging. South Africa was an emerging market under the apartheid regime, and then it's kind of interesting. It's one of the few countries that has gone back to emerging markets. That doesn't mean there's a devolution in society in any capacity. It just means that the market situation has saw increased growth. We have an emerging market there now. So pretty much all of Africa, I would say, except maybe Morocco, but that's like a big maybe. You really have to see if they fall into the middle income trap to be at their emerging market. right? So what we're doing here is once we identify the emerging market, we're then going to say, okay, what is this new middle class going to buy? And this is pretty much healthcare and education. This isn't what I've caught up with. I actually went to a CFA conference recently, and one of the guys at JP and Morgan at the Global Asset Management, he was harking on healthcare. He was doing healthcare in China, but we're going to be looking at India in this case, mainly because it's a little bit easier to get sources on it. So what we're going to be looking at here is, in theory, let's say India is an emerging market, which it is, and we figure out what people are going to buy, and that's going to be healthcare. So we're going to go find healthcare. We're going to pursue healthcare stocks, healthcare positions, stuff like that. Which one has a good option? There you go. There's the methodology. It's going to be two parts: find the emerging market, and then figure out when that emerging market's going to grow in position, a stock there. And the next part, obviously, is hedging and stuff like that, but we'll get to that. So the first way, there's really two ways of doing this. You can invest in individual companies. This is through, if you're a U.S. citizen like me, you have ADRs, American Deposit Receipts. Basically, these are like, if you want to think like shadow companies on the major exchanges that you can invest directly into that are foreign companies. So what I have here, talking about India, is Dr. Reddy's Laboratories. They make pharmaceutical goods, so they're directly tied to the healthcare sector. And as you can see, this explosion, this is a long durée is what we call it in the field, but basically it's a long-term position. And if you go back further, and this is from 07 to 2021, and you can see there's massive growth. And this is not going to slow down anytime soon, right? The problem with doing these individual stocks like this is you really have to know what you're doing. I don't recommend normal retail investors go out and start buying individual, stocks that are, especially individual stocks that are foreign, unless you know how to like value a stock properly, whether that be off growth or value investing is up to you, or you want to do like algorithmic sentiment analysis or something like that. That you can make a lot more money by doing individual picks, but generally there's a lot more risk, right? And like just take this, RDY for example. The CEO of RDY can decide, hey, instead of us doing pharmaceuticals, we're going to go off and do energy, right? And the stock can plummet, and like you can't predict that, right? There are ways to hedge it. You can do like options or something like that, or find like an inverse play. And I have an entire article you can read by clicking here instead on the site when you get down to this part. It's the top 3 easy ways to hedge a position. It's a good read. I recommend you guys give it a shot. The second way of investing in foreign emerging markets is just getting a foreign market for an ETF that's just focused on that market, right? And there's ones for emerging markets everywhere. Wisdom Tree, going back to India, Wisdom Tree is the EPI. This is the I think it's top 100 companies, just based off total revenue. So the most profitable companies in India, uh, and I think their biggest sector in India right now is finance, followed by energy, uh, and then tech. I think it's constantly changing because India is like such a fast-moving economy. It's a pretty cool economy. I recommend you guys check it out if you ever get the chance. There's a lot of like cool articles coming out on like the social stratification stuff. Um, but India is expanding. That's in the story. But yeah, you buy the Indian ETF EPI. EPI. The downside of this is you're not going to capture all the growth, right? Because there will be an ETF is just a kind of a cornucopia of stocks, and you buy it and you get like a little bit of this, a little bit of that. You're not going to capture 100% of the growth that you would normally get through like individual stocks, right? But you're still going to capture the emerging market's overall trend, and you're holding for a long durée here, a long time period. Uh, so EPI seeks to mimic the most profitable companies in India. These are going to be healthcare companies, utility companies, energy companies, and you'll have everything. But because of the emerging market hypothesis theory, that essentially the markets become more and more profitable, the middle class can spend more money, et cetera, et cetera, et cetera, you're going to be making money regardless, right? So there's very little risk in holding ETFs. Uh, you should hedge every single position, but for a majority of ETFs, it's kind of more more of a hassle than it's worth. I know a lot of asset managers are probably cringing when I say that, but you know that's the truth of it. ETFs are killing the fund world. They're too good at what they do. Um, but I mean, you can hedge it if you want. You can either do a currency inverse hedge, or you can find we'll get into this in a second, but a competing emerging market. That's what I like to do. So yes, the two ways are investing in individual picks that are associated directly in the sector you're looking at. So healthcare for India, for example, find a healthcare stock such as Dr. Reddy's, or You could just go buy a straight ETF. So the risk of investing in emerging markets. This is where a lot of people end up failing because they don't really calculate the risk in it. There's a couple of them. One of the major ones is the fact that we're really blessed here in the United States to have the SEC, and they force companies to have quote accurate investment reports. Um, but when you're investing in ADRs, right, or let's say you have access to private equity firms, um, you're kind of at the whim of that country's regulating agency. And in some of the developing markets, they don't really have a regulating agency. I know some of the countries in Africa uh, that funds that I've worked for have invested in have been like, we hope it works, we hope they're accurate, and there's some activist funds that are legitimately fly analysts to, like, let's say a mine in I don't know, Central African Republic, and they'll be on the ground. They'll literally do all the accounting work for the mine just so they have accurate reports. So, but anyways, so there's two ways to really, for the average retail investor to hedge risk, manage risk in these emerging markets. Um, so there's two kind of risks you need to be aware of. The first one is protecting against political destabilization, right? Typically, emerging markets are characterized by a shift in from authoritarian regimes, whether that be a dictator or a regent or whatever, um, to more of a democratic open market process. Uh, but that involves political destabilization. If the regime comes back to power, there's a chance they can crack down on a company or a sector assets, and there goes the emerging market status. So there's a couple ways you can do that. One of the ways I know in the street is to write a computer algorithm that will skim websites to automatically alert you of impending political events. This is called investor sentiment analysis. You kind of have to know how to do Python. It's not hard to do, but it's going to take you probably about, for a diligent person, a week and a half to learn how to do it. For someone who's just laissez-faire learning Python, you can probably get it done in a month. Basically, you're just going to be building a computer program that will, web scrape data, and it will, like, okay, if this word happens linking to this word called semantic linking, then guess what? We're going to alert a red flag. Maybe we'll lower our position by 2% or something. I don't know. It's whatever you want to do. There have been things called flash crashes because of that. But basically speaking, you can either run a Python investor sentiment analysis model to, like, your data is pretty much going to be like congressional reports or speeches and stuff like that. The second way is to do a competing emerging market, right? And this is the one I do because it's kind of hands off. But basically, so there's emerging markets that are basically, an emerging market has to export its goods to make money. So India will export its goods, China will export its goods to either emerged markets or developed countries. So you can go figure out what India in this case is competing with. I don't know if it's China. I just use China as a reference. It could be anything. Um, and you just go invest in them. And it's not a direct hedge, but if India, let's say India elects a regent or something, and it goes from emerging market back to an authoritarian regime, and India just closes off all borders, all commerce exchanges, whatever. This wouldn't happen, but let's just say it does. Then that inverse position you invested in would go up in value. So on the screen right here, we have the hedge investment visualized, and this is a perfect hedge. It's never like this, but the underlying theory is the same. So the blue line is India, red line is China for this example. If India, let's say India's exporting semiconductor chips or whatever, and China's exporting semiconductor chips, and they're directly competing with each other. If India's market cap goes down, China's will rise, and that's called the hedge position. That's what I do because I don't have to build a Python model, right? It's not hard to build. It's time consuming, and no algorithm is perfect. You constantly be on top of it. I just accept the fact that this isn't a perfect hedge, and it'll just protect a lot of my downside risk, right? I just make sure my research is good pretty much before I enter a position. You should be good. The other thing, this is the middle income trap I was talking about. Emerging markets have the risk of never becoming fully developed. Developed countries like the United States, the UK, or whatever. And that's because of our current situation with globalism. Emerging markets, how they become emerging markets is by specializing in resource extraction and manufacturing. Their population says, hey, I can go make a lot of money instead of working on my family farm. I can go work in a factory, right? And in the 90s, we had the migrant working kind of crisis in China, where everybody was leaving the rural farm side, and all the young people, and were going to go work in factories. That's why we had an explosion in Chinese goods in the 90s, and thus an explosion in the Chinese middle class that has continued long and perpetuated to today. So what happens is when you have a large middle class that grows way, way too fast, nobody wants to go work at the factories anymore, right? They want to work for whatever. They want to emulate the upper class. They want to be investors, or they want to be, I don't know, doctors, surgeons, computer programmers, you name it. The fact is, there's less and less people to make the manufacturing goods, and the price of those manufacturing goods and the overhead essentially will rise, which will increase the price of manufacturing goods. Which means, in the world of globalism, the developed countries won't buy the Chinese goods, or won't buy the Indian goods, or won't buy Nigeria's goods, or whatever it is, because they can just go to another country that is still in the emerging market status and doesn't have this middle income trap, and they'll just buy their goods instead. So this is the problem that a lot of emerging markets are fighting right now, is because they are kind of DJ Khaled here, but suffering from success. Their population gets so wealthy, and they develop such like niche skill sets, that they can't compete with the other emerging markets anymore, and globalism kind of leaves them by the wayside. And another issue is the talent they do get, the surgeons, the doctors, the professors, the high talent of society, if you want to call them that. They just emigrate, right, to the developed countries because there's a higher quality of living. So you have a brain drain to the developed countries. So it's this middle income trap that ends up happening. So this is something you also have to hedge in your portfolio if you do an emerging market position. And how you do this is you just follow the GDP and the factory worker statistics. So these are usually published every single day, and then you can always just trace the money. If the cost of manufacturing is increasing, ask why. Is it because it's getting harder and harder to find talent, harder and harder to get people from family farms or villages or wherever they're not really making any money to come work at the factory? If so, well then there might be a chance of falling into the middle income trap. If that's the case, then you should start lowering your position or even liquidating it, because simply put, there's just not much alpha left. At this point, it's been all squeezed out. Go to another emerging market. So let's get into the nuts and bolts. This is what everyone wants: the expected returns of investing in emerging markets, right? So obviously, past returns are not indicative of future returns. Anybody on the street is going to tell you that, and that's true. I can't predict the future. Nobody can. If they tell you they are, they're lying to you. Call them out on their lie. Nobody can predict the future. But if you're holding for a long term, Dahlia's fund does this a lot. Elliott Management does it a lot. Other funds on the street will do it a lot. If you hold for the long term in these emerging market positions, generally you're going to make a lot of money. And I have all the sources up here on this site, so you can go through it. So what you can expect, this is just from the Indian healthcare sector, to go back to that, is 16 to 20% annualized returns, CAGR. And that's just from one sector. And then there's some that are much, much higher. Uh, the Ivy League endowment funds, for example, invest in a lot of private equity firms that legitimately just specialize in emerging markets, and they'll get 50, 60%, you know, and that's insane. And you can mimic this. A lot of people don't know this, and this is why I'm here. Is because I explain these concepts to people. I've taught classes at the graduate level on emerging markets and how to position an investment to best capitalize upon it. And a lot of people don't know. I mean, you don't have to invest in codified you know commodities, codified economies where there's like, yeah, you'll get like 1 or 2% out of one position per year. If you're willing to take on a little bit of risk and you know how to hedge a position properly, and you're willing to do a little bit of research, then you can be making some pretty decent returns. Now, recently the U.S. market has been just out of control. I think the SPY this year is like 23, 24% or something. Yeah, you're probably not going to beat that, right? But if we ever do go back to a pre-pandemic society where tech stocks just aren't dominating the world, um, then this is a methodology that you should be looking at. And I would even argue you should be looking at it now, because this is super cutting edge. But there's an emerging market tech sector that specializes in providing kind of apps and computer programs and low level code, if you want to call it that, it's kind of hard to explain unless you know coding, but it's a lot of like simple back end and front end stuff. Um, and we're seeing globalism and emerging market theory and hypothesis going on there. A lot of people are doing that, like Indian tech stocks. Check that out. So yeah, simply put, if done properly and you do your homework and you know what you're looking for and you know what to do, you can expect between 14 to 20%, just on top of what you're getting in a portfolio. However, that's entry level. Good macro investors can, those are rookie numbers, bump that up into the 30s and 40s range, and even higher if you know what you're doing. The trick, like I said, though, is always managing risk. So, but yeah, there's the numbers for you. All the sources are up on the site. I highly recommend you check it out. So there you have it. Everything you need to know about how to start investing in emerging markets efficiently and not lose. Professional investors on the street employ these types of methodologies all the time, and they see huge returns. It's only fair that you guys get the same information. So, as usual, I'm Chills and Dad here at Chrono History. I teach people how to generate above normal market returns, alpha, and I routinely publish articles on investment methodologies, research, and tips and tricks so that you're better armed to increase that yearly ROI. Uh, there's a free newsletter on the site if you guys want to sign up and remain up to date. I just use it to update people, usually on a once a week basis, Sunday, Monday, whenever I get around to it, on updates in the market, different articles, different methodologies, and stuff like that coming out. So until next time, this is Chills and Day signing off, and I wish you the best of luck in your investment journey.